Hi, everyone. Welcome to another episode of the Entrepreneur Aligned podcast. I'm your host, as always, Jarrod Musick. And today I want to talk about a major change that is coming to tax law here at the end of 2025. So as I'm recording this in 2024, it sounds like we have a long time, but we really don't, because the type of tax law change that we're going to discuss today is the federal estate tax law, and specifically the amount or the threshold at which you can pass things from one generation to another without those amounts being subject to federal estate tax. So this all goes back to 2017 and the Tax Cuts and Jobs Act. A number of the provisions of that legislation were scheduled to sunset within a 10-year time period, which just so happens to be the end of 2025. Now, they do this for a variety of reasons, but the main one is how the House of Representatives and the Congressional Budget Office do budgeting. So changes to policy that sunset after a certain period of time are counted one way versus changes that are open-ended are interpreted to be enacted indefinitely. So when we look at tax policy change, there are a lot of provisions that do follow this pattern. So some of the ones that we're more familiar with were a reduction in the corporate tax rate, a reduction in the top tax bracket on the individual income tax basis, changes to the amounts that are covered in various tax brackets, things around the so-called SALT, state and local tax deduction caps, so that higher tax states were residents of those states were not able to deduct fully the amount of state tax that they were paying, and a variety of other provisions related to business taxes and other things. All of those are scheduled to change right along with the estate tax exemption. But the one I want to talk about today is that exemption amount. So currently, it's at about $13.6 million. As of January 1st of 2026, so a little over a year from now, that amount will be cut down to $6.8 million per person. Now, the great news is this doesn't apply to a high percentage of households, but for the percentage of households that it does apply, many of you who are watching or listening, it's going to be a significant change. So we're cutting that number in half. Now, as a primer on the estate tax exemption amount, each of us gets that exemption. So if you're a married couple, you get to double that essentially, which means in 2025, if you were to both pass away, you could pass on about $27 million of assets without it being subject to the 40% federal estate tax rate. Any amount above and beyond that would be subject to that tax rate. So that's a very large amount of wealth. But as a business owner, that can be something that we run up against, particularly as your business continues to grow, change, build, and increase in value quickly. So even if you're thinking, well, that doesn't necessarily apply to me today, run your financial forecasts out for 3, 4, 5 years and look at, could that potentially apply to me, my family, and my business at some point in the future? So the great part is we have the ability to do things that can move some assets out of our estate prior to the expiration of that exemption amount and prior for it going down to about $13 million per married household. So you can do things in different trust structures that move some of those assets out of your estate today up to that cap of about $27 million. And then should they increase beyond that in the future, they are not going to be subject to estate tax. So a couple of the key structures that I want to discuss. The first one is a spousal lifetime access trust, or SLAT, S-L-A-T. So a SLAT allows you to essentially move assets into a trust. The appreciation beyond that point is considered to be out of your estate because it's an irrevocable change moving assets into that trust. And then a spouse can retain access to some of that trust throughout their lifetime. This can be a really powerful tool, but like a lot of these, they are irreversible, meaning irrevocable trusts. So once you make that decision, you can't just unwind it. We can also look at things where there are annuity trusts, meaning you can contribute assets to the trust and then retain access to an ongoing income stream or annuity payment from that trust. There are a number of rules around both of these in terms of how you contribute, what you have access to, how the amounts that are transferred to the trust are calculated, but this can be another option Another one is actually to put life insurance in place. So you can create something that's called an irrevocable life insurance trust, or ILIT. You contribute assets to that trust, usually to purchase a life insurance contract, or sometimes a life insurance contract that you already own. You contribute it to the trust. It is considered to be out of your estate and therefore not subject to the estate tax threshold. And those life insurance death benefits are available to your heirs when you pass away. So another area where you can move assets that are outside of your estate while we have this increase in exemption amount. We can also look at charitable. So if we're looking at charitable remainder trusts and things like that, you can move assets to a trust where, again, you're going to receive income from that trust for a period of time. And then at the end of that trust, or at the end of your life, the remaining assets are paid out to an eventual charitable beneficiary. Another tool that, if it makes sense, can really help with the estate tax situation and being able to move assets out of your estate in a very efficient way. We can also look at ongoing gifting and giving options. So gifting among family members. Now, this is another area that we can utilize past the end of 2025. So when we're thinking about, there's the lifetime exemption amount, the amount that is exempt to be moved from one generation to another and not subject to estate tax. There's also an annual exclusion amount. So how much can be given every year between family members. So again, this is per person. And you're able to give about $17,000 a year per person from one generation to the next. So again, if you're part of a married household, that's $34,000 per person that you can gift across generations. Now imagine you have adult children who are also married. So now you can do $34,000 per person. So that's $68,000 of gifting that you can do over time. If you have multiple children, multiple spouses, this can turn into a powerful giving strategy that you can do over a period of time while you're not using up that lifetime exemption amount. Or if we've already sort of made that change at the end of 2025 and we're in the $6.8 million per person lifetime exemption amount category, and you don't have the ability to move things out of your estate anymore, we're always going to be able to do an annual gifting strategy. So this is all part of, sort of this parallel tax system that most of us are very familiar with. Income tax. We have our W-2 income, we have business distributions, we have income from investments, other things that are taxed on an ongoing basis. So when we start talking about estate taxes and gift taxes in what's considered to be the consolidated tax system, meaning they're going to get you whether it passes at your death or through gifts during your lifetime that are above that annual exemption amount. These are all things that we need to be able to plan around. And that's really an interesting planning process because there are a variety of different vehicles, some of the trusts that I discussed briefly here in this podcast, and other tools that are available to us to make sure that you're able to be as tax efficient, working within the tax code, complying with all the tax laws, paying your fair share, doing all of that, but being smart with your tax planning so that you're able to transition businesses and other assets across generations. One of the areas that we've really seen this come up is if you have family-owned businesses that you want to make sure that they stay within the family. If you have a significant estate tax bill that you haven't appropriately planned for, that can cause a forced business sale. You basically have to find somebody to buy the business so that you can take the proceeds, pay the estate tax, and move on and do something else. We have clients who own family businesses that employ dozens and hundreds of people that they want to be able to have multiple generations own, operate, grow, and benefit from. And so doing that in accordance with your estate tax planning is something that is really important to do. So again, there are a variety of different structures that you can utilize to do this, perhaps a family limited partnership, a dynasty trust, some other vehicles that allow you to work around that estate tax exemption amount, preserve the value of the business, continue its operation, continue its benefit that it's providing to customers, employees, and the family itself. So we have a very unique window of time where we have certainty certainty around a pretty large estate tax exemption amount, and we want to make sure that we take advantage of that here at the end of 2024 and into 2025. So I know I didn't get into specifics about how you fund these structures, how you design them, what the limitations are, why they might work for one person or another, because that's really beyond the scope of this fairly simple podcast. Send in your questions. If we get a lot that are about a specific type of trust or a specific type of strategy, I'm happy to do a deeper dive podcast on specific strategies. But hopefully this is helpful from an overview perspective, looking at this window of time that we have available and some of the more commonly used strategies that are available to make sure that you take advantage of this planning opportunity that we have. If you'd like more information, some of our deeper dive content on these strategies and others, head over to entrepreneuraligned.com. We have lots of goodies in our blog section and in our FAQs over there. And you can reach out to me directly through the website. Happy to answer any questions that we have. I do know this is in our disclosure, but I want to hit on it one more time here before I close out. This is not tax, investing, or legal advice. Please consult your tax professional, your CPA, your attorney, your financial advisor. And if you don't have any of those, reach out to us. We're happy to help you get some on board so that you can make good decisions and decide what makes sense for you and your family. Thank you so much for giving me some of your valuable time today. Let's all take advantage of the great estate tax planning opportunity that we have here in the next year and change. And I'll be back with you again soon.